students. Today I welcome you to week 9 lecture 1 on specialized documentation. So we all know that international trade is a huge block for a country to make economic progress and achieve economic growth. But every country, be it developing or developed country, go through a lot of hurdles, especially the exporters who don't know what specialized documentation they have to furnish before exporting their goods. So this lecture will delve into the various pre-shipment documentation that are required by each exporter and without which the export goods or the consignment can fail to deliver and can be rejected by the consulate or by the customs. So we move ahead and see what actually we are going to discuss in this entire lecture. So we will go through the introduction to pre-shipment procedure and various stages that are involved in pre-shipment stages. So we will go through what actually pre-shipment means, what are the stages involved. Then we will start step by step looking into the pre-shipment procedure. The first step is approaching foreign buyers. So we will look into how would an exporter approach foreign buyers, what can be the various channels that they can choose among a variety of alternatives given to them by their trade ministries or by the policy options. The second stage is making an inquiry and on the exporter's part offering various pro forma invoices to the importers who are interested in buying the exporter's goods. The third stage can be confirmation of order. Once the importer or the buyer is ready on behalf of the exporter consignment, they can decide whether they want to proceed with the order or not. Once they confirm, we move on to the next step, which is opening of letter of credit. This is a very specialized document and we will learn what actually this means. The next step is arrangement of pre-shipment finance. This is a very crucial step for the exporter. The next step is production or procurement of goods. So every exporter, before making the export, before sending the shipment, can make sure whether they have the actual products they want to export or what they have promised to the importer or buyer. It may happen that the exporter has promised a good which cannot be produced by them. So they can move ahead by procuring the goods from a local producer at a low cost. So this stage is really important for the production and procurement of goods by the exporter. The next step is packing and marking. This step also marks a crucial point in the whole pre-shipment procedure documentation. What has to be packed? It is the exporter's goods. And what are the specific requirements that the importer country wants or the consignee wants is relevant for the exporter. And the exporter must know in detail what are the packing and marking specifications per se required by the specified importer. The next step is pre-shipment inspection. It may happen that a particular importing country wants the exporter country to make sure that the goods are of a particular quality or they match a particular standard. This may be true for industrial goods. This may be equally true for the consumer goods. It so happens that in various developed countries, they have specific requirements to match for the quality assessment of the products that are to be exported. So, this stage is really important for the exporter to understand and adhere to. This is mandatory for the exporter to match what the importer nation wants from their goods. The next step is removal of goods from factory for exports. Then we will see how would an exporter obtain insurance cover. So this is about the protection of exporter for their goods and for other requirements by the exporter. The final step in the pre-shipment procedure is appointment of a clearing and forwarding agent. So, a clearing and forwarding agent can be appointed by the exporter on his behalf to proceed with the shipment. So now, dear students, let us move ahead and look at what actually a pre-shipment stage means. So as mentioned before, export procedure is a very tedious process, particularly for exporters who don't know the intricacies and specific nuances of the international trade procedure. Nowadays, it is a lot more smoother because various ministries and trade bodies are trying to create a lot of capacity building workshops for the exporters. A lot of promotion agencies are trying to let the exporters know more about the intricacies of the trade procedure. Export procedure consists of a lot of commercial and regulatory formalities, and it is really mandatory for every exporter to complete these formalities, without which their export procedure would cease to exist. These formalities are really complex in nature and they take a huge time on the part of exporter. And these steps involve considerable documentation. So, this makes the exporter very much important to have all the information and correct knowledge about all the requirements, not only from the exporting country but also of the country in which they are destined to import. Pre-shipment stage involves any stage which starts from securing the sales contract up to handing the goods over to the courier for export. So in this entire window, the exporter prepares and aligns all documents, goods and compliances needed so the shipment can be accepted, cleared and loaded. So any stage from the deciding of the contract, the offer of the contract, confirmation of order, till the point when the exporter hands over the entire export consignment to the shipping company and it is boarded on the vessel, this whole stage is called the pre-shipment stage. Now, let us discuss in detail the various steps involved in the pre-shipment procedure. So, the very first step is approaching foreign buyers. So, who is a foreign buyer? Any buyer who is interested in the product of a different country, in the product of a different company from a different nation, and they want to approach that particular country to buy those products. So, an exporter must create a demand in the foreign country for their products. And after understanding the demand for their products, they might want to venture into various alternatives that are available to publicize their products. And these various channels are sales promotion, public relations or publicizing their products. So, an exporter may try to involve various strategies of promoting their sales. Another method can be advertising in international media. So, a number of media outlets have international dedicated papers or international dedicated segments to advertise these products. For example, in Financial Times, there is a dedicated segment for commercial section in which you can advertise your premium business-to-business categories, specifically focusing on capital goods and specialty inputs, etc. Another approach which has become a frequent used method nowadays is participating in trade fairs and exhibitions. So, in New Delhi, every year the Indian Trade Promotion Organization (ITPO) organizes International Trade Fair at Pragati Maidan, in which a number of exporters can participate and exhibit their products for the benefit of the foreign buyers. So in this entire process, they may approach the foreign buyer through providing them samples, the quality assessment, what are the procedures, what is the process that they are following. So this approach can be a beneficial approach for the exporters to approach foreign buyers. So in essence, an exporter can choose from these various available alternatives to approach a foreign buyer interested in their product. The next stage appears when, after creating a demand for their products, maybe a foreign buyer, after getting interested in an export commodity, may put up an inquiry through email or other correspondence method to the exporter. So, an inquiry is a request from a prospective importer about description of goods, what is the standard, what is the quality, what is the size, the weight or other specifications, how much time would they take to deliver, what is the industrial process, what are the standards, what are the labor standards, what are the environmental standards that their production process is being followed. All these things can be inquired through an email inquiry or other correspondence methods by a prospective importer to the exporter. Once an exporter receives such kind of inquiry, the exporter must process it immediately without any delay, and they must make an offer through presenting a pro forma invoice. Now, what is a pro forma invoice? A pro forma invoice is an abridged or an estimate invoice which is sent by this exporter to the prospective importer or the interested buyer. So, I'll give you an example of what an inquiry could look like. So, this is an inquiry put up by a Dubai-based food importing company. They are looking to source basmati rice with the particular product and specifications they require. What is the standard that they are looking for? It is 1121 basmati rice, which is 5% broken with a moisture of less than 30%, and it should be produced within the time frame of 2023 to 2024 to 25. The particular quantity that they want and what would be the estimated time of delivery they want it within 30 days of order of confirmation or the letters of credit. They want specified what is the certificate of origin. This clearly means that they want the source of the basmati rice. Where is it produced? Is it actually produced in India, or is there a third country where it is being produced? So all these terms and all these specifications they can inquire in this inquiry email. They have put up the HS code, which is a harmonized system code for the classification of commodities, and they just request a pro forma invoice with the best price that the exporter would want to charge for the buyer for this basmati rice. So this is a specimen of how an inquiry could proceed. After receiving a kind of this inquiry by the importer, the exporter must immediately respond to this query and present a pro forma invoice with the best price and the specifications of their product. It is up to the buyer now, after receiving the offer or the pro forma invoice, after looking at the mismatch or if it aligns well with their specification demanded, and if it is up to their request, they can finally confirm the order. So the next step is confirmation of order. So once the negotiations are completed on the part of both exporter and importer, and both the buyer and seller are actually satisfied with the pro forma invoice, with the inquiry and offer made, and they sign and agree to the terms and conditions of the contract, they finalize the order. How does finalization occur? the exporter sent 3 copies of pro forma invoice to the importer. And once on receiving these 3 copies and on the approval of the importer for this confirmation of the order, the importer returns these copies by signing them and addressing and giving his or her willingness to accept the order. So this is how an order is finally accomplished and finalized by the importer and exporter. Let us now move ahead and see what the next step involves. So the next step is a very crucial step in the trade procedure, and it is important equally for both exporter and importer. This is opening of letter of credit. So letter of credit is a kind of promise which is given by the importer's bank on the behalf of the importer or the buyer, that upon the completion of the documents that are required in the entire exporting process, the importer would be paying the full-fledged amount that is against the exporter. So it is actually a promise by the bank that the export proceeds will be given fully to the exporter on completion of the export assignment, and once the consignment reaches the importer. So as we all know now, it is the most appropriate and secured method of payment, and it is very well adopted by the international trade community to settle trade transactions. Once the export contract is finalized, the exporter requests the importer to open letters of credit in his favor in the importer's country in a particular bank. As mentioned before, letter of credit is a guarantee given by the importer's bank that the payment will be made to the exporter on receiving stipulated documents. So these stipulated documents can be a certificate of origin, a bill of lading, order of contract, and other documents as and when required by the appropriate authority in the importing nation. So here is an example of how a letter of credit is opened. So if we take the example of an Indian exporter who is about to export a consignment of machinery to France. So the importer in France, or one who is buying these Indian machinery, will request a bank in his country, that is a French bank, to open a letter of credit in the name of the exporter in India. So payment will be released after the bill of lading and invoice is submitted to the bank in the importing country. So this is how a promise to pay the Indian exporter by the French importer is established through the letters of credit. Now we step ahead and see what happens next. The next step for an exporter is to arrange pre-shipment finance. So before shipping their consignment, it is really important and crucial for the exporter to have ready finance in their hands. For what? There are a number of things that an exporter needs, because they have to produce or manufacture the goods that are required by the importer. To fulfill that order, they need a variety of things that can be raw materials, or that can be inputs. So the exporter, in order to fulfill these export order, needs procurement of a lot of material. For example, it could be capital goods. It could be machinery. It could be some specified level of technology. So for these things, the exporter requires pre-shipment finance so as to procure these inputs so that it is easier for them to produce these goods. And it could be other components as well. It could be processing and packaging of goods. It could be finance needed to transfer goods to the port of shipment for final export. So this is also a very important step in the pre-shipment procedure documentation. Now, how can an exporter avail the pre-shipment finance? An exporter, particularly an Indian exporter, can avail pre-shipment finance from both commercial banks and from public sector banks. But they can do so only against confirmed export order and a letter of credit, without which no bank would be available to provide pre-shipment finance. It is a kind of proof that the export order has been ceased, an export order has been secured, and the bank would in return provide some pre-shipment finance. There are specific examples where export orders can be financed. For example, SBI, PNB, Bank of Baroda, HDFC Bank, ICICI Bank, etc. And other banks also provide pre-shipment finance to Indian exporters. Now, what is actually needed to avail this pre-shipment finance? To secure this pre-shipment finance, some requirements are really basic. For example, an importer-exporter code. This is the first crucial step. Then a KYC, know your customer form. Last 3 financials, last 3-year financials, bank statements, GST filings, goods and services tax filings. And the second most important thing, as mentioned before, is an order of contract or letters of credit. Both of them can suffice to avail pre-shipment finance by the exporter from any bank. It can be SBI, it can be PNB, Bank of Baroda, HDFC, ICICI Bank, or any other commercial bank present in the country. Now let us move ahead with the next step, which is production or procurement of goods. So the exporter, in order to fulfill the order, needs to have the goods handy. For that, they must manufacture the products in the various quantity and sizes and quality that they have offered in the inquiry mail to the buyer. If they are not the one producing or manufacturing the good, and they are about to source it from local companies or local producers, then they must go ahead and procure it as soon as possible in order to avoid any delays in the shipment of the goods, because in the offer that they have made, they have already promised a particular date of delivery. For example, in the previous example that we discussed, we saw that the particular inquiry that the Dubai based food importer made, they wanted the shipment to be within 30 days of the order of confirmation. So in order to meet that deadline, the exporter must manufacture and produce any material and procure any material that is required and that is really crucial for the manufacture of the products. So on securing the pre-shipment finance from bank, then only they can move ahead, and then the manufacturer or the exporter makes necessary adjustment for the production of the ordered goods, and the merchant exporter procures them from the domestic market as per the specifications of the importer. So as mentioned and discussed, some exporters can pass on the export order to local producers for execution. Why would they do so? Maybe because they would be doing it at a low cost. They would be sourcing it from local producers at a much lower cost. The next step is packing and marking. So packaging is a very important step, because if there is a loophole in the packing and marking requirements and it does not match with whatever the importer's country has specified, then the entire consignment can be rejected, it can be seized on the customs, and it would be futile for the exporter, it would be a loss for the exporter, and they would be the one bearing the losses. So it is very crucial for the exporter to understand what a packing and marking stage is and what it all requires from the importing country, and which are the institutes or which are the organizations that they can get support from and get guidance from. So proper marking and packaging with necessary details is important. What are these necessary details? First of all, the port of shipment and destination should be specified accurately. There must be no mismatch between the port of shipment, the location, and the destination. If there is a mismatch, then the entire consignment would be rejected and all the losses will be borne by the exporter only. The second most important thing that has to be kept in mind by every exporter for packaging and marking step is the country of origin. Country of origin marks a crucial step in both proper packing and marking, and actually in other documents as well, like letters of credit, because it serves a number of purposes. The first purpose of a certificate of origin is availing tariff concessions, without which no country would offer any tariff concessions. For example, if an Indian exporter is exporting to Indonesia a particular amount or a particular variety of a product, and India and Indonesia have agreed upon a tariff concession for that particular product. In case the Indian exporter is not well aware of correct source of origin, and they default on that and provide an incorrect certificate of origin, then whatever tariff concessions Indonesia would have offered to an Indian exporter would cease to exist. So the Indian exporter would lose out and they will have to either pay more or maybe their entire consignment may be rejected. So in all, it would be a loss for the exporter and it would put the exporter in a very difficult situation. So it is very important for an exporter to know well ahead what is the country of origin and specify it very accurately as exactly in the documents of exports. The third important thing is gross and net weight of package. So it is very important both in terms of the shipping company and both for the receiver as well, because it depends on the gross and net weight of package only that which vessel the shipping company will choose for the particular transfer and transportation of the good to the destination country. Now there is a particular agency in India which guides the exporters on particular packing and marking specifications, and it is the Indian Institute of Packing. So for further guidance, the exporters could contact and reach out to Indian Institute of Packing, IIP, in Mumbai. Now after this, it is very important to know correctly what are the requirements in terms of quality and standards that a particular importing country wants from the exporter. And in case it is not followed, it is not agreed upon, then the entire consignment can be rejected, one thing, and the other most important thing is the importer country can decide to block the exporter for a very long period of time in case these standards and quality checks are not maintained. So this entails a very important step in the pre-shipment documentation procedure. What happens in pre-shipment inspection? If the goods that are to be exported are subject to compulsory quality control. So now it depends on the importing country. It can differ from various importer country to importer country. Indonesia might have different quality standards, and USA, United States of America, may have different standards and quality assessments. Okay, so how does an exporter do this quality assessment? So there are dedicated Quality Inspection Council under the Quality Council of India, and we have the Regional Export Inspection Agency to arrange for inspection and also obtain an inspection certificate. Without this inspection certificate, it would not be useful for the exporter to export this consignment, because at the customs in the importing country, this document would be required for further clearance of goods and handing over or receiving of the goods by the importer. In India, 90% of the items exported are subject to this quality inspection. Now, a very important question is, who does this pre-shipment inspection? So there are various agencies. The first, as we have seen, is the Export Inspection Agencies, EIA, under the Export Inspection Council. It comes under India's statutory system. The second one is third party inspection firms. So there are various third parties or companies that can do inspection and quality assessment for the customers in the different country for an export consignment in the Indian territory. For example, we have SGS, Intertech, BV, TUV, and they can be different third party agencies on the demand of the importer. So an importer sitting in a European country in EU can have a particular demand made for inspection and quality assessment by any other third party. So it is very frequent and rampant in agricultural products by the EU. The other pre-shipment inspection is also done by various dedicated commodity boards or regulators, but these are specifically meant for particular sectors. For example, we have Tea Board. So Tea Board can perform quality inspection for any tea related products. Or we have Spices Board, and we also have APEDA, Agricultural Production Export Development Authority. So APEDA would like to do some quality assessment and inspection before the shipment of goods for agricultural produce. Similarly, we have Marine Production Export Development Authority, specifically meant for marine products. For example, various forms of fishes, tuna, salmon. Okay, so in all, we can learn that we have three mechanisms, three ways that pre-shipment inspection can be done, or three agencies that can do pre-shipment inspection or quality assessment. One is Export Inspection Agency, which comes under Export Inspection Council, or also Quality Council of India, and third party inspection firms, and the third is Commodity Board or regulators. The next step, once the goods to be exported have been given a quality assessment certification, an inspection certification by any of these agencies, the exporter now moves ahead with the removal of goods from factory for exports. So under the Goods and Services Taxes regime in India, the removal of goods from a factory for exports is treated as a zero rate supply. This means that no GST is levied on the supply. Unlike under excise, no formal permission is required for removal of goods from factory for exports under the GST regime. Now, the next crucial step is obtaining insurance cover. Why do we take insurance? In the terminology of exports, insurance is really crucial. Why? Because we have to protect both our goods. and it is really important for the exporter to decide which policy they want to take to protect their goods and what is the objective of the protection for their goods. What are they protecting their goods from? The first is they are protecting it from commercial issues. The second is they are protecting it from political risk. For example, commercial and political risk during the transportation. So, there are two types of policies that an exporter can avail for covering their products from any risk, be it commercial or political, during transportation. The first is Export Credit Guarantee Corporation policy. This covers political and commercial risk. The second is Marine Insurance policy. It is if the price quotation agreed upon is cost insurance freight. Now, let us look deeply into what ECGC policy for insurance cover is. It provides coverage for Indian exporters against the risk of non-payment by foreign buyers due to commercial or political issues. What can be a commercial issue? Insolvency of the buyer. So, if the buyer in the importing country, a foreign buyer, defaults and they have no money to pay for the order, the order has reached the destination, they had confirmed the order earlier, the order has reached, but they have already declared themselves insolvent. The company has declared itself as insolvent. In this scenario, the ECGC policy can help protect the exporter from the losses. How much loss can they bear? It is about 80 to 90% of the value of the goods. The other risk that is involved in transportation of exporting goods is political risk. It happens so in the times of war or other uncertainties. For example, in the case of any mishappenings in a particular country, the latest case can be the Bangladesh crisis. So, in Bangladesh, we had a crisis last year, right? So, any consignment that was bound from India to Bangladesh could have faced a lot of difficulties when it reached the ports at Bangladesh. So, in these cases, the ECGC policy, if was availed by the exporter beforehand, could have covered around 80 to 90% of the losses. The final step in the pre-shipment documentation procedure is the appointment of a clearing and forwarding agent. Since we have entirely discussed how complex an international trade or export procedure is for an exporter, the number of documents that are required and are mandatory for the exporter to file and submit it to the shipping company, and further also to be delivered to the importing country, we know how complex and time consuming the whole process is. So sometimes, and many a times also, the exporter may appoint on his behalf a clearing and forwarding agent. What it helps with? The agent helps with the smooth clearance of goods from the customs and also helps with the preparation and submission of various export documents. Some clearing and forwarding agents also make provision of storage of goods at various stages of export process. So, in case there is a delay on the part of customs officials at any stage, and if your good is a perishable good, it requires smooth storage of that good. So, in these scenarios, the clearing and forwarding agent can also play the role of securing storage and warehouse facilities for the goods to be exported. And they may decide how many days the delay can be and for how many days the warehouse facilities are required. So, this is the final step in the pre-shipment documentation procedure. Finally, we have to secure a place for the shipping of our consignment. Once the export contract is finalized, the exporter reserves the required space in the vessel for shipment. On accepting the exporter's request, the shipping company issues a shipping order. What is a shipping order? The shipping order is an instruction by the shipping company to the commanding officer that the goods, as per details given, should be received on board for transportation. Finally, we have to arrange, or the exporter has to arrange, internal transportation up to the port of shipment. It can be done either by road or railways. If the exporter is choosing going ahead with the railway option or a railway wagon, the railway authorities issue a railway receipt which serves as a title to the goods. The exporter endorses the railway receipt in favor of the agent, clearing and forwarding agent, which enables him to take delivery of goods when it reaches the desired destination. So we have looked closely at the various steps involved in the pre-shipment documentation stage. What are the various procedures? We have gone through it step by step. So here we can conclude that yes, exporting is a really tedious and complex phenomena, and it requires every exporter to be fully informed of all these pre-shipment formalities and procedures. Accurate information is crucial at this stage, and it eases a lot of difficulties and smooths the entire exporting process. It supports the exporter to engage agents like a clearing and forwarding agent. So, engaging a clearing and forwarding agent smooths the entire process, and it is a huge support for the exporter. In case of any discrepancies, in case of any delays, the clearing and forwarding agent could help with the storage of goods. Dear students, in the last lecture, we discussed about the pre-shipment documentation, which is really important and crucial for the exporter to understand, to be well informed of, in order to go ahead with a smooth flow of export consignment. In this lecture, we will discuss post-shipment documentation. Actually, in detail, we would be looking at what post-shipment means and what are the various documentation, what are the various steps and stages involved and required for this stage to be effective. So, the various steps involved in post-shipment documentation are the submission of documents by the clearing and forwarding agent to exporter, export declaration, shipment advice to importer, presentation of documents to bank for negotiation, dispatch of documents. In this stage, the bank, the negotiating bank, dispatches all the list of the documents as a file to the importing country or the importer bank. Acceptance of bill of exchange, letter of indemnity, realization of export proceeds, processing of GR form, realization of export incentives. So these are the various stages that we will be looking ahead to understand post-shipment documentation. So let us first introduce what post-shipment documentation actually refers to. So, in the last lecture, we had delivered the goods or handed over the goods to the shipment company through the clearing and forwarding agent. So, the post-shipment procedure will start as soon as the goods are loaded on board the ship. So, the exporter has chosen the particular vessel through the shipping company, and once the entire export consignment is loaded onto the vessel or the ship, we say that the post-shipment procedure or post-shipment stage has begun. The post-shipment stage mainly consists of procedure for realization of export proceeds and incentives. Export proceeds means the payment for the goods or the exported goods. Incentives are all the various schemes or benefits that an exporter can claim from the government according to the policy. Thus, we can also call this procedure as export realization and incentives procedure. This particular stage and procedure has two goals. The first, to get paid according to the agreement or as specified in the letters of credit. The second stage is claim the incentives or refunds that an exporter is eligible for according to the policy and schemes of the government, and close any compliance issues. The first step in post-shipment documentation is submission of a list of documents by the clearing and forwarding agent to the exporter. What are these documents that the clearing and forwarding agent must submit to the shipping company? The first is a copy of invoice duly attested by the customs. Drawback copy of the shipping bill which is provided by the shipping company. Export promotion copy of the shipping bill. A full set of negotiable or non-negotiable copies of bill of lading. Original letter of credit, export order or contract, or any other document that a particular importer or importing country demands according to their policies and schemes. The next step is export declaration. In this step, the exporter needs to declare through an export general manifest within 24 hours of the shipment of the vessel, or in case of an aircraft carrying the consignment, before 24 hours the aircraft leaves. What does it help with? The export declaration on behalf of the customer, on behalf of the exporter, helps the custom authorities to manage and control the export process, ensure compliance with customs officials' export regulations, and it serves as a crucial step in monitoring and getting accurate export statistics and data for trade purpose. So it is at this stage that all the customs officials maintain trade statistics, how many shipments are boarded and they are destined to which country, and thus this step is a crucial step in post-shipment procedure. The next step involves shipment advice to importer. After the goods are already shipped, they have boarded the vessel and the vessel has started from the port. The exporter intimates the importer about a number of issues. These number of things that are intimated to the importer are the date of shipment. What is the actual date when the vessel started or began the journey from the port of shipment. What is the name of the vessel or the container? So there are a host of companies which provide containers for shipping purposes on the port. Which company and which container have been used for the shipment of the consignment? The name of destination, which country and which location the export consignment is destined to. And what is the tentative date on which the vessel would be arriving on the port of destination. The exporter also needs to send one copy of bill of lading to the importer. Following this step, the documents are then presented to the bank for negotiation. These documents are also called negotiable set of documents. In all, there are 10 documents that are needed to be submitted to the bank for negotiation purposes. The first document is bill of exchange. Second document is bill of lading or airway bill. So in the case of an aircraft carrier, an airway bill need to be furnished. Third document is the original letter of credit. Fourth document is customs invoice. Fifth document is commercial invoice, including one copy certified by customs. The sixth document is packing bill, packing list. Seventh document is foreign exchange declaration forms. Eighth is exchange control copy of the shipping bill. Ninth is the certificate of origin. And final document is marine insurance policy and a duplicate version of the marine insurance policy. All these set of negotiable documents are then dispatched. The bank negotiates these documents to the importer's bank, and this negotiation must happen according to the manner specified in the original letter of credit. Before negotiating these documents, the exporter's bank checks them to ensure that all formalities have been complied with and all documents are in order. Once the bank is fully satisfied with the accuracy of the documents, the bank sends the bank certificate and attested copies of commercial invoice to the exporter. So there are a number of bills of exchange, types of bills of exchange that can be issued, and these are called documentary bills of exchange. There are two types. The first is side draft, the other is usance draft. Side draft is issued immediately, while usance draft can be made for a future date. For example, it can help the importer to pay after 60 days or on a future date. It could be 30 days, it could be 60 days, it depends on the agreed timeline. The next step or the document is letter of indemnity. The exporter can get immediate payment from his bank on the submission of documents by signing a letter of indemnity. Letter of indemnity means that the importer has not yet made a payment for the export consignment, but the exporter's bank has already paid the whole amount to the exporter. If in case of any default by the importer, the exporter is liable to pay the huge amount to the bank because they have signed the letter of indemnity. So, in the event of non-receipt of payment from the importer, the exporter will have to pay the principal amount plus interest plus any other bank charges. So, this is the whole concept of letter of indemnity. The next step is final realization of export proceeds. Once the documentary bill of exchange is received, the importer will release the payment either in case of side draft or usance draft. The exporter bank receives payment from importer's bank and credits it to the exporter's account. This is the next step, which is processing of guaranteed remittance form. On the receipt of export proceeds, the exporter's bank submits the duplicate copy of GR form to the Reserve Bank of India, intimating it about the receipt of export proceeds. If the details are correct, the Reserve Bank of India treats the entire transaction as complete. If the details are inaccurate, then the whole process will repeat again, starting from the first step. Now let us look into what is the GR form. It is kind of a traditional RBI export declaration form. Nowadays, we don't have the GR form, but many books still use the term process the GR. Nowadays, we have the shipping bill plus EDPMS or EBRC. Together, they play the role of the guaranteed remittance form. Now, once the export proceeds have been released, it is really important for the exporter to avail any incentives that are liable to him or her. There are a number of export incentives that Government of India promises for the exporters. It could be in the form of cash refunds, it could happen in the form of duty credits, or also in the form of e-scripts. So if it is in the form of cash refunds, money is paid back to the exporter directly into their bank account after shipment. Now, in order to avail any export incentives, the exporter must specify it in the shipping bill. So, the government reimburses any taxes. It could be central, state or government taxes, or also local duties that the exporter had paid on the purchase of any inputs that were used in the production of exported goods. These duties can be refunded and it can take the form of duty credits. So, in this form, a credit balance is made in the exporter's account and this balance they can use in the future transactions. E-scripts is a form of digital duty credit and it is specifically issued on IceGate or DGFT website in India. Before releasing these duty drawbacks, duty scripts, e-scripts, what should bank actually check? The banks check for documents title, wordings exactly as in LC. At this stage, there should not be any discrepancy. If any discrepancy is found at this stage, then the exporter ceases to receive any kind of remission of duties or taxes that they paid on the import of any products that were used in the production or manufacture of the exported goods. The bank also checks for consistency in names, addresses, quantities, specifically HS codes. There should not be any kind of inaccuracy in the mention of HS code, the prices and Incoterms. The third most important thing is the date of shipment. There should not be any mismatch, any wrong in the date of shipment, the issue and presentation or delivery period. So these are the three things that serve important purpose for the banks in order to release any kind of duty remission to the exporters or incentives to be secured by the exporter. Post-shipment export incentives in India are of various kinds. The first is duty drawback. Second is RODTEP, which is remission of duties and taxes on exported products. The third is ROS CTL, It is specifically meant for apparel products. And the final is EPCG, which is export promotion of capital goods. So specifically EPCG is meant for import of capital goods at zero or concessional rates, but it carries with itself an export obligation, a condition to use it for exports as a multiple of the duties that was remitted. So under RoDTEP, there are a number of incentives for the exporter to avail. This RoDTEP scheme was launched on January 1, 2021. Earlier it was named as Merchandise Exports from India scheme. But because Merchandise Exports from India scheme was deemed not compliant with the WTO policies, it ceased to exist and it was replaced with RoDTEP scheme in 2021. The RoDTEP scheme is wholly WTO compliant and it cannot be leveled in the WTO dispute panel for any undue service to the particular sectors. It does not violate WTO procedures. It does not violate WTO's Agreement on Subsidies and Countervailing Measures Agreement. It is a very competitive strategy by the Indian government to level playing field for Indian exporters. So, Indian exporters cannot be at competitive disadvantage at the world platform. It levels up the playing field at the international platform. It neutralizes tax burden on exports and make them more competitive at the global stage. So, here we can see that the goal of post-shipment documentation is simple: get paid on time and unlock export incentives. The exporter must ensure right documents, right sequence and right dates, and it is really important to fix issues early. For example, the name or HS commodity code should be exactly as specified and there should not be any default or any incorrectness in the consignee name.